Hello, everyone. Welcome to We Are Centered CEOs. It's great to be joining you. My name is Angie Rice, and I'm a CPA, forensic accountant, and small business owner. And I'm here with my partner, Janet Semenova. We're here today to talk about data, qualitative data and financial data, and how using data can really help you make better business decisions to increase your profitability and the long-term value of your company.
So what is data? Data is essentially a combination of information that you can gather, collect, and then analyze to make decisions or gain knowledge. We use data every single day in our lives, whether that be in our business or our personal life, to make decisions about what we do. When we're driving, we're gathering data about whether there's traffic, whether the weather is good or bad, and we need to slow down or speed up. Our brains are designed to process data very, very quickly. But when it comes to running our business, a lot of times we separate what we think we know to do from what we actually need to do, because we make our decisions based on emotions rather than on facts. We make, as business owners, a lot of decisions based on gut feelings. And although oftentimes our gut feelings might be accurate, if they're not followed and based on factual information and data, we can actually cost ourselves a lot of money and a lot of lost productivity.
And data is compelling for many of reasons. You have qualitative data and you have quantitative data. And when you combine the two and really understand its meaning, you can be able to better predict outcomes. Qualitative data, when collected in totality, can become facts. For example, if you have 100% of your reviews a 5 versus a mixture of 1s and 2s and 5s, that is telling you that there is something happening and there is some level of breakdown in your customer service, which becomes more factual when there's that evidence to support that. So let's look at a company real quickly that's getting 5-star ratings. They're obviously moving in the right direction. But if all of a sudden you see a 1 or a 2 out of 1,000 reviews, you'll want to look at that to see if it's an anomaly or if you're starting to see a trend where all of a sudden there is a substantial number of increases in lower ratings. That could be contributed to, for example, one employee that isn't properly trained. And that solution can be solved pretty quickly if you're able to analyze those different reviews collectively. So we talked about quantitative data and qualitative data. So let's really define the two types of data. Data that can be measured numerically is oftentimes considered the quantitative data, the financial data. I tend to gravitate towards this data. It's your profit margins, for example. You can look at your profit margins in totality, or you could look at your profit margins by product and services and see that some products and services are more profitable for you than others. If you charge service fees in your business, you can analyze whether those service fees are billed by the hour or whether you're increasing or you're decreasing your services fees based on market conditions, or maybe there's a reason to warrant an increase as a result of a particular employee who's becoming more experienced. So you might have different service levels based on a law firm, for example, oftentimes will charge a different rate for its paralegals than for its senior partners. And then overhead items, obviously the cost associated with overhead. We look at conversion rates. If you have leads, what is the percentage of those rates as it relates to a lead becoming a client? And Janet, I'll let you kind of dive into the qualitative data.
Perfect. So qualitative data is what I naturally gravitate towards. It's all of the intangible information that we use to make decisions and that we collect and analyze in a more philosophical manner than just looking at numbers. Qualitative data is soft data. So it's things like the testimonials that you get. It's the emotion that your customer portrays when they're having a conversation with you. Do they feel like you're providing them a good service? When you're having a conversation with your client, do you feel like they're happy? Do you feel like they're satisfied? Do you feel like you're answering all of their questions and helping them create an outcome that they desire? It's hard to measure how somebody feels. It's hard to measure happiness. It's hard to measure satisfaction, but we try to measure it and we try to quantify it so that we can analyze it. It's also your client relationships. It's how your clients perceive you behind the scenes, how they talk about you behind closed doors, what they say about your business when they're talking to their friends and their family. Your supplier relationships. Do you have good relationships with your suppliers? Would your suppliers prioritize you if you picked up the phone and said, oh my gosh, I'm desperate. I need to get this shipment out ASAP. Can you help me out? Or we had this issue with a customer. I need you to kind of work overtime to resolve this issue. If you have really good relationships, strong relationships with your suppliers, and you have mutual trust and respect, oftentimes your suppliers will go the extra mile for you. But they only will do that if you have a really good relationship. Again, very hard to quantify the quality of your relationship. But generally speaking, you know how good or not great it is. It's also your expertise and your product knowledge. Somebody, for example, my background is in healthcare. You know, when I was first finishing graduate school and starting at my job, my expertise was pretty small in my field. As I worked there for years and years, my expertise grew substantially. Again, hard to exactly quantify expertise, but my knowledge base, my confidence, my comfort level, my ability to make split-second decisions got much, much better because I had that practice. Even though I may have scored really well on my exams when I was just out of school, it doesn't mean that I was as expert in my field as I was having years of practice and having years of experience. It's also your company culture. Like, how do your employees feel about you if you have team members? What do they say about working for you when they're not talking to you, when they're talking to their friends and their family, or they're talking to each other? Is the general mood in your company positive, or is it kind of negative? Do they feel like they're supported? Do they feel like they're encouraged and pushed to achieve greater things? All of those things are intangibles, but extremely, extremely important for running a successful business. And it's your employee satisfaction, of course. You know, you can, of course, create employee satisfaction surveys and analyze those surveys, but how your employee really feels is hard to quantify. Again, because it's difficult to quantify emotions. It's difficult to quantify how your brand is perceived, even though we know that certain brands have a really positive brand image and certain brands have a not so positive brand image. And large companies spend millions and millions of dollars to work on their brand image, even though it's not quantifiable, because they know that having a positive brand image translates to having more sales, having a better brand, being more profitable at the end of the day.
And Janet, you touched on the trends, you touched on surveys and gathering information. And certainly as your qualitative data becomes collected and gathered and maintained, and you look at the trends, you can certainly see correlations between qualitative information, such as if you're receiving 5-star reviews versus 3-star reviews. If your employee satisfaction is high, you're going to see lower turnover ratios, and you're going to see employees who fill out those surveys providing more positive feedback, as well as your supplier relationships. You can look at the subjectivity versus the objectivity and really analyze how can we improve a supplier relationship using some sort of matrix that says we need to have so many touch points, maybe having a contract in place where it really spells out your agreement so you have things that become more measurable as it relates to evaluating that supplier relationship. So there are so many ways to take qualitative information and analyze it. The same goes to can apply to quantitative data. Really, a conversion rate is a conversion rate, whether it's a 20% conversion rate or 75% conversion rate. The why is really explained by the qualitative data. Why do you have a high conversion rate? Or maybe you're seeing a positive trend in your conversion rate. Let's say it went from 20 to 40%. You're going to want to understand what happened and why you saw that increase. You want to be able to measure it so that you continue to do the positive things that are driving that higher conversion rate. So knowing when you're doing things in your business that are creating improvements, and at the same time, things that are resulting in a lower performance level, you want to be able to quickly identify the why and the qualitative information that is causing those numbers to either be favorable or unfavorable, so that you can modify your business and make improvement as quickly as possible, or to ensure that you're staying on track.
And I want to quickly touch on the fact that as small business owners, a lot of us are experts in our industry, but that doesn't necessarily mean that we are experts in finance or accounting or gurus in math. I, for example, am not a math guru. My statistics skills are like bare minimum. My finance skills are just bare minimum. But I understand that collecting data, analyzing data, and using the numbers in our business is exceptionally important. And so even if you are an expert in your field, whether you're an acupuncturist or whether you're a travel advisor or an interior designer, and you did not go to school to be a business owner, you have to understand that if you want to run a successful business, you want to run a sustainable business, you want to elevate your business, be able to delegate responsibilities, replicate successful outcomes, and create longevity for yourself where you can grow your profits year after year, you have to understand the numbers. And one common misconception that a lot of business owners that we speak to have is that they think just because they have a really good CPA, or a great bookkeeper, accounting firm, that they don't need to understand their own numbers because somebody else is taking care of them. And that is a huge, huge misconception, because you can have the best accountant in the world, but your accountant is not necessarily an expert in your industry. And so when your accountant comes and looks at your data and looks at your books and sees that, these are your profits, these are your write-offs, they don't necessarily know what areas of your business you need to focus on to lower your overhead, to increase your revenue, and to improve your bottom line, because they are not working in your business. The only people that really understand the insides of your business are yourself, your team members, and also if you bring on a professional business development coach that can help you out. But that's a big misconception, and I think it's really, really important to address. And Angie is a CPA, and it's a perfect example I want you to talk about. Angie doesn't do the accounting in our business, even though she's a CPA. She outsources that responsibility, but guess what? She certainly looks at our books and our numbers.
Yeah, it's, a lot of times we find ourselves using financial data for tax purposes and reporting purposes, or if you're gathering that information to apply for a loan, a business loan with a bank. But really, the benefits of your financial data and being able to analyze it over periods of time is that you establish trends in your business and you're able to make business decisions using your financial data. Really, the benefits of knowing how to interpret your financial data is so that you can make better business decisions going forward. Sometimes those business decisions are, what are we doing right and how do we continue in that direction? So if you see marketing campaigns that are creating revenue for your business, you're going to maybe consider spending more money on those types of marketing campaigns, versus if you're seeing an expense that you're incurring year over year and you're not getting an ROI, you want to evaluate whether you should eliminate that expense altogether. So when understanding your financial data, it's really looking at the trends and comparing it to the industry and comparing it to your past performance, as well as the goals that you set for your company. If you're going to expand your business, you're obviously going to have some costs associated with that. So you're going to have to balance the revenue and your cash flow in order to recoup the investment that you make to grow your business. And another really important indicator, and like Janet mentioned, like your accountant doesn't know the ins and outs of your business, and they're not necessarily going to be privy as it relates to every industry. A 20% profit margin for one industry might be exceptional, whereas another industry might look at a 5 to 10% as an exceptional profit margin. And the same as it relates to revenue. Some businesses have to generate substantially more revenue to earn the same profit as a business that has a fraction of the amount of revenue, because it's a much more costly business. Those businesses that have products versus services have a significant different business model, as well as an expense structure. So you really have to know your industry data to really benchmark whether you're outperforming, underperforming, or whether you're on par. Additionally, you have to look at economic indicators. Certainly, the pandemic affected most businesses in one way or another. For some, it affected the business quite negatively, created pauses in businesses, created a cash flow concern, and most of us, as a result of that, have been more attuned as to our financial data because we're managing our businesses so differently. And for some businesses, the pandemic created opportunities for them to reevaluate revenue opportunities and maybe introduce new products and services to respond to the pandemic, and they've been able to increase the value of their business as well as their profitability. So every business has different models, because as a business owner, we get to pick and choose our services and products, and whether we want to be dialed into a niche or whether we want to be more expansive. So knowing your financial data is just part of doing business. So really take a look at what you know about your business. If you're needing to learn more about your business, look for resources that can really help you better gather, collect, look at technologies that can help you synchronize your data as well. So we talked about qualitative data and quantitative data, and really to analyze this data to really understand its meaning, you really have to merge the different data points, both qualitative and quantitative data.
So we like to have an extremely holistic approach to our businesses. We run 2 companies. We have to be really streamlined and really organized in order to keep everything straight. So we call ourselves centered CEOs because that is really what we aspire to be. We want to be centered. We want to be holistic. We don't want to overly focus on profits and forget company culture. We don't want to overly focus on company culture and not be profitable. We want to be able to grow and scale at a sustainable rate without crashing and burning or running out of resources and time, which sometimes we all do. And that's okay. You know, we have to find balance in our lives. But as far as analyzing data, we really think of it as a wheel, meaning that every single spoke on this wheel and every circle that you see is equally important. And without one of them, the whole thing kind of falls apart. So when you look at analyzing your data, you have to look at all of these different components. Again, the quantitative data, the tangibles that you, whether you like math or not, have to be able to look at and really understand for your business so that you can benchmark and compare yourself to other businesses in your industry, as well as the qualitative intangible data that really creates your brand identity. So your client demographics, who are your ideal clients, and are you reaching your ideal clients? Are you currently servicing the clients that you want to be servicing that will have the greatest benefit and the greatest ROI from working with you? And if you're not currently servicing your ideal clients, how can you shift that and change that to reach more ideal clients? Very important data. Revenue sources. Where is your revenue coming from? Do you have one revenue source or do you have multiple revenue sources? If something like the pandemic were to hit again tomorrow, what would you do? Are you prepared? Do you have income streams that are sustainable in, world natural disasters or world events? Can you overcome a recession? Can you survive another pandemic? Are you diversified? Your testimonials. Are the clients that work with you generally happy? There's always going to be outliers. And one thing I liked about statistics is the bell curve. If you've ever taken a statistics class, you remember the bell curve. You have the bell curve. How is your bell curve? Everything in the middle of the bell curve is usually representative of the norm. So if most of your reviews are 4.5 and 5 stars, and you have a 1-star review somewhere out here, that's okay, because there are going to be customers that you don't make happy. There are people in the world that you can't satisfy. There are going to be issues that arise that are outside of your control. That is okay. You want to look at the outliers. If your bell curve is 3-star reviews and you have 1 or 2 5-stars and 1 or 2 1-stars, but the majority are 3. Well, that should tell you that in general, your business is doing just a mediocre job, that you really definitely have room for improvement. So look at that bell curve. And you can even, that's a pretty easy, I'm sure there's a calculator that can create a bell curve for you now. We don't have to do what we used to do when I took statistics back in the day, where we had to like manually plot it out. But it's not a bad exercise to do. You know, if you have 50 testimonials or 100 testimonials, look at what the averages are and look at where your outliers are and why they're there and what happened and how can you prevent those outliers in the future. Or if your outliers are really high level reviews, what did you do right and what can you do more of? Because the more testimonials you have that are positive, the more referrals you're going to get. Again, qualitative data that you can use in a quantitative manner.
And really, within each of these categories, you really have a way to analyze your data and really gather information that is qualitative and quantitative that can become more measurable in your decision making. Cost control is a perfect example. A lot of our cost control in a small business is discretionary. You make decisions. Right now during the pandemic, a lot of companies are evaluating whether they need to be incurring the rents that they're incurring or whether they want to shift more employees to a virtual model. There are certainly, that's a cost item. It's a large cost item for many businesses, but you really have to evaluate the ROI on rental space. If you're foregoing team building and the opportunity to properly train and educate by giving away office space across the board, that could become problematic long term. However, a solution might be to maintain your office space, but to reduce the amount of space where people have to, share offices, or they come in, 2-3 days a week, and then someone else uses the space on the other days. So cost control is really evaluating the ROI on an expenditure, as well as ways to eliminate expenses. And I think I've worked in bankruptcy type matters where it was really, we were consulted as a way to evaluate how quickly we could generate cash, but at the same time, we were concerned about creating as much cash flow as possible. So we had to evaluate situations of, yes, there was immediate need for cash, but sometimes you had to spend money to make more money. And, oftentimes we were representing the creditors committee that really understood that if they wanted to get a larger percentage of reimbursement on their debt, then they had to recognize the business decisions that needed to be made in order to allow that to happen. And I think as business owners, we focus so much on eliminating costs at the expense of recognizing some of your expenditures actually should be increased if it's driving your ROI. If spending money makes you money, then you need to evaluate those expenditures. And whether we're talking about ways to create productivity in your business, if we're talking about different revenue sources, or like I've just been talking about cost control, the only way you're really going to be able to effectively determine the cause and effect that impact these different components of your business is segregation and really understanding how to partition data. If you look at your marketing spend, for example, as one big line item where you're spending $10,000 a year on marketing, you're probably not going to be able to link that to your revenue in terms of what's driving your revenue. However, if you're very effective with that data and you're looking line item by line item as to how you're spending your marketing dollars, and you're tracking as best as possible the causation associated with that spend, you'll be able to identify of the different 5 to 10 marketing strategies that you've implemented, which of those 5 to 10 are effective, because typically there's 2 or 3 that are working, and there's those that are costing you money and not necessarily driving business to you.
And productivity, this is huge. How do you measure your productivity? There's quantifiable ways to measure the productivity. So how much can you get done in an hour? How many clients can you service in a day? And there's also the qualitative measures of productivity. How productive do you feel? If you are setting goals for yourself, are you achieving those goals in a timely manner? Are you setting realistic goals? Are you setting goals that are too big and you're not able to achieve? Or are you setting goals that are not as big as they could be, and so therefore you are not as productive as you really ought to be? Part of productivity is being mindful and intentional and setting aside time to hyper focus so that you can get into a flow state. How many times a week are you setting aside time where you are completely focused on a particular task in your business, where you're working on your business, whether that be writing, whether that be development, whether that be creating new programs, strategizing, whatever it is? How many times a week are you creating those opportunities for yourself and for your team members? Because remember, our brains are not created to multitask. When we multitask, we actually are just hyper diverting attention from one thing to the other to the other. And so we're looking over here, then we're looking over here, we're answering a text, replying to an email. We actually get a lot less done when we are multitasking than if we were to separate those activities and just hyper focus on each activity on their own. That's something that's been studied. You can read lots and lots of great articles on it in Inc. and in Forbes and in the Harvard Business Review. But there's been a lot of data that supports the fact that we are not able to really hyper focus. And so if your entire day and your team's entire day is full of distractions, your productivity is going to be lower than what it can be. And you may not even recognize how much more productive you and your team members can be if you set aside those flow state times, those uninterrupted times where nobody's allowed to email, nobody's texting, nobody's disrupting you, really only phones are on only for emergency purposes, how much more you can get done. And how do you measure that? Well, it's a little bit of a trial and error. You implement a few days a week where you have this carved out specific time for you and your team to work on particular tasks, and you see how productivity improves. Again, quantifiable methods and also qualitative methods where the team might say, you know what, I feel like I'm getting a lot more done. Like I feel I can focus better. I'm being more creative. I'm having more ideas. It's hard to measure an idea. It's hard to measure creativity. It's hard to measure really like the quality of your writing, for example, if you're writing a blog. But when you step back and you evaluate past performance and you can see, wow, the team over the past 3 months since we've implemented these times where it's like uninterrupted time, where it's flow time, they've come up with like 5 amazing ideas that we're now implementing. Or the team we notice, is a lot happier and feels a lot more productive themselves. They report that they feel more productive. They report that they feel more inspired. They report that they feel more organized. Again, qualitative data, but that's really, really important for your overall success of your business.
Yeah, you can't emphasize enough how important productivity is. And I think Janet really touched on the structure of a workday and how that can really add value to your performance. Additionally, I think that there's also substantial research that really speaks of the importance of expertise and delegating responsibilities accordingly. So niches and specialties really help with productivity. So if you have a diverse team and your services are also very diverse, recognizing specialties and assigning certain types of engagements, or if you're working with different types of clients and you segregate those clients into different segmentations and allow different employees to service the same types of clients, it's going to increase productivity because they're going to be able to streamline servicing those clients significantly better. Same with really looking at the tasks that are being performed. I think sometimes we focus on a job description when we hire somebody, but we fail to recognize that once you hire someone, that employee really recreates and reinvents that position, and you need to modify that position to really play off their strengths. And where there's areas of weaknesses, you look to hone those weaknesses, or maybe you look at taking or carving out responsibilities that would be more productively performed by somebody else. We see in companies where as people get promoted, sometimes as part of that promotion, they continue to perform responsibilities that are outside their pay grade or below their pay grade. So as a business owner, it's really important to evaluate tasks that are being performed by your employees and whether or not that task is being properly performed by the right person. You don't want executives performing administrative work that can be performed at a much lower pay grade. It's not adding as much value to your business. You want them to be performing tasks that are equal to or greater as it relates to their pay grade so that they're providing more value. And as the business
And
owners, we
themselves.
oftentimes are guilty of that ourselves, right?
Yeah. That's huge. I mean, as a business owner, we talk a lot about our whole motto is elevate, delegate, replicate. What do we mean? Elevate your brand, elevate your image in your community, elevate how your clients perceive you, elevate the testimonials, elevate the services you provide, elevate your expertise, delegate everything that you are not exceptional at, delegate everything that is below your pay grade, outsource what you can't delegate to your team members to other people in other parts of the country or the world that have that niche and that expertise that can do your job, that can do that particular task a lot better, more efficiently, effectively, and productively. And replicate predictable, successful outcomes. If it works in this area of your business, take what's working and replicate it and try it out in other areas of your business. Because the more strategic and intentional you are, the more mindful you are of what you're doing in your business, and the more you are aware of what is working, why it's working, what you're doing to make things better, what marginal improvements are leading to big changes in your business, the more you can replicate those things. And when we replicate predictable, successful outcomes, we become a lot more productive. We become happier. Our team becomes happier. The company culture, whether it's just you and an assistant or you and 100 employees, improves. And when you have predictable outcomes, guess what? You can scale. Because you cannot scale if you don't know what works and what doesn't work. You cannot grow your company and your team if you don't have processes and procedures in place so that everyone is on the same page. Because guess what? If you start growing without those things, if you don't have the data to back up what is working and what's not working, and you bring in new employees and new team members, you're not going to have consistent results. And then what happens is that, and this happens to big businesses every single day, it happens to small companies, but it happens to large corporations as well, the quality and the customer service suffers. And we're seeing it, Angie and I own a travel company, we're seeing it in the travel business right now, because what's happening in the travel industry is, of course, the pandemic hit, and all of these companies, airlines, large hotel chains, had to furlough a lot of their employees. And because the furloughs went on for an extended period of time, they were not able to bring them back in time, and a lot of those people had to go out and find new careers. And now all of a sudden we have this explosion of demand in travel. Everybody wants to travel, and they can't bring on and train employees fast enough. And guess what? Their customer service and the quality of service has dramatically decreased. And hopefully it will go back up, but hold times at airlines right now are 7 to 8 hours. It's not because the airline can't go out and hire 100 people. It's because the airline can't go out and hire 100 people and train them to provide the same quality of service that their previous employees who had been with the company, who understood the processes and procedures, who got the workflow, who had the expertise, were able to provide. And so it's really, really important to plan your growth strategically, because it's better to grow slowly and sustainably than to explode and fizzle.
Right. A lot of failed businesses fail during their growth model because oftentimes you have to spend money in order to allow for that infrastructure and the investment to take place. So you really have to balance it. If you're going to spend a lot of money on marketing to really increase your sales, but you haven't trained and prepared for staffing, the ripple effect is going to be problematic if you can't service all of those clients that are coming to your business as a result of the dollar spent on marketing and advertising and sales. So you really have to be well prepared for growth in order to weather the storm. There is always that storm before the business can realign, and you have to be able to predict that and time it as best as possible.
Using data.
Of course, using data.
Of course. So data, again, just to recap what we wanted to talk about today, data is quantitative information that you gather from your business. It's the cost of doing business. It's your overhead. It's your revenue. It's how much money you're bringing in and what you're left with at the end of the day. Because I can't say this enough. We see this. This is obviously, we are on, we're live online and on social media, but there are coaches and programs every single day that call themselves multiple seven-figure businesses. It doesn't really matter what your revenue is if you are not running your business productively, because you can have $2 million in revenue and be $1 million in the hole. you can have $1 million in revenue and have $800,000 in profits at the end of the day. So you really need to understand where your expenses are going, where your revenue streams are coming from, how you can lower your expenses strategically while increasing your revenue, or how you can actually increase some of your expenses because it's going to exponentially increase your revenue. And then, of course, the qualitative measures in your business, which are all of those intangibles, the feelings, the company culture, your reviews, your testimonials, how people feel when they do business with you, how happy your employees and team members are, how happy you are, how satisfied you are, and are you following your mission and your core values? Are you living the mission of your business every single day?
Thank you so much for tuning in. I hope that this information was very helpful and allows you to sit down and reassess how much information you're using to evaluate your business. And the statistics are showing that 50% of small businesses, as well as large businesses, are utilizing more and more data to make business decisions, not just financial decisions, but human resources decisions and decisions related to their overhead spending. When you assess your data and you gather this information, it can be so compelling looking at historical trends to project future results in your business can result in 20-30% increases in your profitability. Thanks again for joining us.